Hey guys, welcome back. In today's video, we are diving deep into the topic of AMC dividends, Adam Aron's latest announcements, and the growing desperation among short sellers for shares, along with other critical developments that have been shaping the AMC landscape. Let's start by focusing on a post that has gained significant attention. AMC dividends are projected to come as early as 2026, possibly in late 2026, and more realistically by 2027, with a firm expectation by the end of 2027. However, there are several prerequisites for this to happen. Debt covenants must be lifted, the company's debt must be restructured, and cash reserves need to be strengthened through outperforming capital expenditures. Until all these financial foundations are firmly in place, AMC has the flexibility to influence its stock price. But the real game changer for investors will be the establishment of a dividend yield. The discussion around AMC issuing dividends is especially exciting for retail investors, often referred to as APEs, because it directly impacts the mechanics of short selling. For those unfamiliar with how dividends affect short positions, here's the key point. When a company pays a dividend, those who are shorting the stock are responsible for paying it first. In the case of AMC, short sellers have created billions of synthetic shares. If AMC were to issue a dividend, these synthetic shares would obligate short sellers to pay out massive amounts, potentially billions of dollars, depending on the dividend size. Even a modest $1 or $2 dividend could result in a catastrophic drain on short sellers' capital. Over time, this financial pressure could eliminate many shorts entirely as their liquidity is continuously drained. This is why the mere possibility of a dividend creates so much excitement and speculation among retail investors. Timing is crucial, and the speculation ranges from 2026 to the end of 2027. What makes this timeline plausible is AMC's recent performance and the strength of its fundamentals. Looking at the box office results this quarter, the numbers are extraordinary. As of mid-quarter, AMC has already exceeded $2.3 billion in box office revenue, with 11 more days left in the quarter to potentially surpass $2.7 billion. This outperformance demonstrates that AMC is consistently exceeding market expectations, which directly strengthens its cash position and ability to fund dividends or other strategic initiatives. Essentially, AMC is now capable of generating higher profits from the same box office revenue due to its improved operational efficiency and strategic cost management. This not only bodes well for potential dividends, but also for the company's long-term stability. Another major factor to consider is Adam Aron's recent communications, particularly regarding his own holdings in AMC. Adam Aron has repeatedly clarified that due to U.S. securities regulations, he cannot legally purchase more shares while in possession of material non-public information, commonly referred to as NNPI. As he stated, he currently owns outright 975,000 AMC shares and has an economic interest in an additional 3.6 million shares, bringing his total exposure to over 4.6 million shares. Importantly, he has not sold a single share in more than 3 years, and over 2/3 of his target compensation is tied directly to AMC stock rather than cash. This demonstrates that Aron's incentives are fully aligned with the company's performance and, by extension, the interests of retail investors who continue to support AMC. Understanding Aron's position helps explain the broader implications of his statements. As the CEO, Aron's financial interest in the stock means that any increase in AMC share price, especially during a squeeze, translates into significant personal gain. Even considering a conservative floor price of $1,000 per share, Aron's 975,000 AMC shares represents a massive sum, and the potential upside during a squeeze could multiply his wealth exponentially. MNPI, while legally preventing Aron from buying more shares, also indicates that he possesses information capable of moving the market significantly. This could be related to potential dividends, discoveries regarding synthetic shares, SEC actions, mergers, or other transformative developments. The uncertainty around this information is one of the key reasons why short sellers are increasingly desperate. The ongoing tension between retail investors and short sellers is heightened by these factors.
Despite limited trading volume, retail investors continue to purchase AMC shares aggressively at current price levels, sustaining upward pressure and demonstrating resilience against market manipulation. This persistence is essential because it maintains the stock's stability and ensures that it remains listed, even as short institutions attempt to suppress the price. The long-term dedication of retail investors has been a critical factor in preventing AMC from collapsing under the weight of massive short positions and synthetic shares created by hedge funds. The broader context is also essential. Short sellers have already sunk billions into AMC, yet the stock has remained resilient. The SEC's historically lenient regulatory approach has allowed many manipulative practices to persist. But if concrete evidence of synthetic shares or illegal market activity emerges, particularly evidence that Aaron could present, regulatory intervention could dramatically change the playing field. For retail investors, this means that sustained buying combined with potential regulatory scrutiny could finally force short sellers to cover their positions at enormous cost. In summary, the combination of AMC's strong fundamentals, Adam Aron's strategic position in MNPI, and the ongoing support from retail investors creates a perfect storm. Dividends, when they eventually materialize, could act as a powerful weapon against short sellers, draining their capital and liquidity. The timeline for dividends may span from 2026 to 2027, but the structural improvements in AMC's business, including strong box office performance and cash flow management, indicate that the company is well prepared for this next phase. Retail investors, by understanding these dynamics and continuing to hold their positions, remain a vital force in sustaining AMC's growth and applying pressure on shorts who are increasingly running out of options. The alignment of CEO interests, operational strength, and investor commitment makes this one of the most fascinating chapters in AMC's story, and it is clear that the company is building the foundation for long-term success and a potential dividend game-changer for the market.
The narrative surrounding AMC isn't just about dividends or Adam Aron's position, it's also about the desperate state of short sellers and the structural pressures building in the market. Short sellers, who have been attempting to suppress AMC's stock for years, are now facing a perfect storm of retail buying pressure, increasing synthetic share exposure, and fundamental improvements in AMC's business operations. Even with off-exchange trading and manipulative tactics, short sellers are finding it increasingly difficult to maintain control, and this is reflected in the growing mismatch between supply and demand for AMC shares. The pressure is not hypothetical, it's very real, and retail investors are beginning to see the tangible effects of their collective actions on the market. One of the most critical points to understand is the ongoing creation of synthetic shares. These are essentially artificial shares that short sellers manufacture to mask their positions or to sell shares they do not own. While synthetics allow short sellers to temporarily manage the market, they also create a ticking bomb. The more synthetic shares exist, the higher the floor price for AMC becomes, because when the inevitable short squeeze occurs, these shares must be bought back at full market value. This is why the floor price of AMC is rising steadily, even when trading volume appears low, because each day more synthetics are generated. In other words, short sellers are literally financing the conditions for their eventual losses. The desperation of short sellers is evident when we examine off-exchange trading data. AMC and GME trades continue to be funneled away from public exchanges into dark corners of the market, making it harder for retail investors to influence price discovery. Yet, despite this manipulation, retail investors remain steadfast, consistently buying shares at low prices. This consistent demand not only counters suppression attempts, but also ensures that AMC stays resilient, regardless of the hurdles imposed by off-exchange practices. It's a clear demonstration that retail investors are not only participants in this market, they are actively shaping it, even under the most challenging circumstances. Another key factor in AMC's current dynamics is the role of the SEC and regulatory oversight, or the lack thereof. Historically, the SEC has been remarkably lenient with institutional traders and hedge funds, allowing practices that exploit retail investors to persist with minimal consequences. Fines and penalties imposed on these institutions are often negligible relative to the scale of their market manipulation. This lack of enforcement has emboldened shorts and allowed synthetics to proliferate, but it also means that if Adam Aron or AMC can present incontrovertible proof of manipulative practices, it could trigger a regulatory crackdown. Such a crackdown would fundamentally alter the playing field, forcing shorts to cover massive positions and releasing the